and welcome to Money Matters TV. I am Mike Dever, founder of Brandywine Asset Management and host of today's show. My co-host is Dan White, president and CEO of Daniel A. White and Associates, and our guest today is Mary Fischer Nassib, co-founder of Sow Good Now. Well, hello there, Dan.
How you doing, Mike?
Hey, real good, thanks. I thought we'd start off the show talking a little bit about something that's happened recently in the financial markets, and that's the failure of Silicon Valley Bank. And with all the turmoil in the banking industry, what should consumers be aware of regarding their money in banks now?
Yeah, it was kind of frightening a couple of weeks ago when we had not only Silicon Valley, but Republic, and then there was a Signature Bank as well. I think people need to relax and calm down a little. I mean, I think the banks are fine. One thing you have to understand about Silicon Valley, I mean, it wasn't mom and pop out there. These were startup tech companies. I think it was 75% of all depositors had over the $250,000 FDIC limit. And the situation out there is similar to really any type of bank. I mean, if I gave a bank $100,000 and they're not just going to sit the money, just sit it in the coffee jar, they're going to invest it. They're probably buying longer term treasuries or bonds, something where they can earn a higher rate of return than what they're paying me. That's banking 101. Now, if I go to the bank in a year and say, hey, I'd like to have my $100,000 back, that's fine. They probably have that. They have that and they can give it to me. The problem arises when everybody that has money at that particular bank, if they all wanted their money all at once, I got news for you. That's going to be a problem for any bank out there because they don't keep that much cash on hand. And then the other issue that we saw that I think really comes into play, I actually did a radio show on this. Back in the early 1900s, they had a similar type of bank run, and J.P. Morgan actually told the tellers, count the money out very slowly. So they couldn't take all the money out all at once. Well, today, with technology being what it is, you don't go to the bank and get your money from the teller. You sit at your laptop computer in your office and you transfer to a different account. And that's kind of what happened out in Silicon Valley. There was wind that they were having trouble with some of their investment portfolio. Some advisors told some big people to pull money out of the bank. And they basically had a run on the bank and they had to get taken over. I mean, that's true, like I said, of any bank out there. But how often does everybody at the same bank say, I want my money all at once? So I think for all intents and purposes, your money in the bank is probably pretty safe.
So this was a true bank panic, like we saw in A Wonderful Life in the movie. And you got to explain your money's not sitting here at the bank. It's
right.
Lent out for something else. And in this case, I guess a lot of the money was in bonds and other types of securities. So
yeah, and as interest rates went up, those bonds and those other securities lost value. And when Silicon Valley had to sell them, they had to sell them at losses. And we're talking not $100 or $200. We're talking billions of dollars of losses, and that's where the problem arose.
Well, I mean, historically, banks have been the safest place, and you started out by saying you think they're still secure. But what other alternatives are there for people to place their money in that's safe and gives them a reasonable rate of return?
Yeah, I mean, if you're looking for that safe, that cannot lose money type situation, I mean, I think insurance companies are just as good a place as banks. You're talking about fixed annuities, which a long time have been considered the equivalent of CDs, only on a tax deferred basis. And quite honestly, because you buy a 3-year annuity or a 5-year annuity, they oftentimes will offer a little higher rate than the bank CD because, again, they might have back-end surrender charges, which preclude the people from taking the money out early. So I think insurance companies, I mean, basically people ask me sometimes, what is an annuity? Well, it depends on the type, but the simplest way of saying it, it's a savings account with an insurance company rather than a bank. So I think if you're looking for that safe, can't lose money, you're looking at insurance companies and banks.
And then it's backed. It's not the FDIC back. It's backed by the security of the insurance company.
The security of the insurance company in every state in the United States has what they call a life and health insurance guarantee association. And they're in the 250 to 300 range, very similar to FDIC. So it's very similar.
Okay. And what kind of rates are they getting on those now?
Today, I mean, you're in the 4 to 5 ranges on maybe 3, 4, 5 year deferred annuities. You're going to be up in the fives, so
Okay. Very
good
good.
rates. Yeah.
Yeah. So, what are the fundamental differences between then insurance companies and banks and how they invest the money that they take in?
Yeah, I think that's kind of interesting. And I've been telling people this is one of the reasons I think insurance companies have the edge on banks as far as the safety of your money. Because the example I used a little earlier was if I gave the bank $100,000 and in 6 months I say I want my $100,000 back, they're required to give it to you if it's not in a CD with an early withdrawal penalty or something like that. But if it's in a money market account or a savings account, they're required to give you those funds. So when you buy an annuity product, let's say you bought a 5 year annuity from an insurance company, they have two things going for them. Number one, there's no cost to get in, but they have back end surrender charges. So it might go something like if you take the money out in the first year, you pay a 5% penalty. The second year, 4, 3, 2, 1. After 5 years, there's no penalty. So again, the bank takes your money, they invest it for in a 5 year investment. And if you want the money out early, they'll break that. But who's going to pay the penalty? Not the insurance company. They're going to pass that on to you. And a lot of insurance companies have also added these things called market value adjustments, which protect them in this type of rate environment as well. So, for example, not only if you wanted your money out in, say, the third year, you've got a 3% surrender charge. But let's say interest rates have gone from 2% to 5% like they have in the past 12 to 15 months. Not only do they hit you with that surrender charge, but they have what's called a market value adjustment, kind of another penalty for you to get your money back out prior to the term of the contract. So again, if you're never going to have a run on an insurance company because the insurance company is not taking a loss, the customer is, and that's why I think they're a little safer.
I see. Yeah. Whereas at Silicon Valley Bank, when they needed to meet withdrawals, if they were to sell the securities they had underlying those deposits, they would have had to sell those at a loss.
And they're not
And
passing that loss on to the customer; they're eating that
right,
loss. That's the difference. Yes.
that's the difference. Okay. And the money, are they investing in similar? The insurance company and the banks, are they investing in
Yeah, a lot of
similar
times they're
instruments?
buying treasury bonds. I mean, back in the day, treasury bonds weren't paying anything, but now they are. I mean, the two year treasury before Silicon Valley was up over 5%, so they were buying 2 years and 5 years and maybe some 10 years. We've got that inverted yield curve. So the short term we're currently paying more than the long term, which, doesn't make sense. Kind of tells us a recession is coming. But they're doing the same thing. They're buying maybe some corporate bonds. They might be buying some mortgages, that kind of thing. Very safe fixed income instruments.
The yield curve's been inverted a while, and we haven't had that recession. Is
I
it
know, and
something
that's
you?
it's 100% reliable indicator. So it's one of those. It's coming, but everybody's like, when's it coming?
Right. Yeah. It's starting to get like a broken clock, right?
Yep,
It's going to be right at some point, but it's going to take a while.
that's exactly
Um,
right.
okay. So I have a question here. That's one of our viewer audience questions. It's from Jerry Jenkins in Boston. This question is, what's good about ETFs?
Well, first, let me tell you what an ETF is. It's called an exchange traded fund. So, people buy mutual funds for the diversification. So when you buy a mutual fund, if you bought like Fidelity Growth, you're going to be in the stocks of about 100, maybe 150 different growth companies inside that mutual fund. Now, an ETF, kind of the same thing. It'll track an index. Most of them track indexes, but the taxation's a little different. With a mutual fund, you might have not even taken anything out, but because that mutual fund is buying and selling inside of there, at the end of the year, you might get hit with a capital gain. You might get hit with some dividend income because they pay them out to the shareholders. You're not really going to see that as much with the ETF. So I think you're going to have more favorable tax treatment. They're easier to trade. For example, if the market was crashing at 10 in the morning and you called Fidelity and said, I want to sell my mutual fund, they'll say fine, but it's not going to happen until 4 o'clock in the afternoon when the market closes. ETFs are traded just like stocks, so they can be traded at 10 in the morning, 11:30. It doesn't matter. You get a lot more diversification with ETFs because some funds even might just buy a couple of stocks and they might buy a handful of ETFs. Well, if you bought an S&P 500 ETF, you're basically buying the market. You're buying 500 different investments. And if you combine that with, say, a Russell 2000 ETF or a small cap ETF, you're really getting a lot more diversification than you would in a fund. And finally, they're very low cost. I mean, you're not paying a whole lot of fees in ETFs. So they have become very popular today, and a lot of the mutual fund companies offer them as well. But they're a nice alternative to what the traditional investments were.
That's great. Hey, thanks for the answer there, Dan. Very complete. I appreciate that.
Yep.
And if you're interested in asking a question on Money Matters TV, here's how to send in your questions.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Thank you, and welcome back to Money Matters. Our guest today is Mary Fischer Nassib. She's co-founder of Sow Good Now. Hello, Mary.
Hi, Mike. How are you doing?
Good, thanks. So we first met back in 15 years ago, easily, probably, when my son was playing football on a team with your son John, and I just remember John being like one of the, if not probably the best player on the team. So you're now active. Yeah, it was great. I remember asking him one time, because Matthew was running back, about making sure Matthew's protected back there. And he says, "Oh, I certainly will, Mr. Dever. I will." Great kid. He was great.
Thanks. You got great boys too. Hi, Dan. Nice to see you too.
Good to see you, Mary.
Okay, so tell us a little about. I mean, that's a quick side there, but tell us about your background, your family, and your work.
Absolutely. So I do have 3 sons. The John that you mentioned, he goes by Cooper Manning because he is the only one of 3 sons that didn't make it into the NFL. So I also have 2 daughters, and sports has been a real big part of my life and who I am. I graduated with a degree in economics from Villanova. I was outside hitter, middle hitter for that team, and was one of the first Title IX recipients for a scholarship at the school. In high school, I learned a lot about myself and integrated a lot of other principles that I developed from my high school volleyball coach. She was a 4-time state championship winner and probably one of the most winningest high school volleyball coaches in the nation today. But what I learned was that once you start winning, everyone expects you to win. And there were many games that we were behind, but doubt creeped into our opponents. And it was because of our reputation that we were actually able to capture the game and consistently capture those state championships. So how does that fast forward in life? I always had this calling, like I wanted to do more. And as I got out of college, I got a company car and a paycheck, and driving down 202 in the night, it's dark. I would wake up in the morning and drive again. It was dark. And I said, really, is this what life's all about? And had my kids and thought, all right, this is the way you can impact the world in a positive place. But as luck would have it, they just kept playing sports. And I thought, how are we supposed to get involved in the community when they keep playing 3 teams a kid, 5 kids, 15 schedules a year? And it wasn't until my middle son was at Penn State, and he was a walk-on there, Carl Nassib, and he was up for all these awards. He went from walk-on to All-American. And one of the awards was for the Vince Lombardi, and they flew us to a hospital. They flew us out to Houston. And in the morning before the event, we actually visited a children's hospital, MD Anderson. At that point, I walked through the rooms in the hospital with my son Carl from Penn State. We're in Texas, and the other one was from Ohio State. And I noticed how all of the parents and the children responded to their presence. And I thought, wow, this is a real life changer for me. If I can teach these athletes how to give back, and I can integrate that into their lives and deepen their understandings at the college level, because think about it, these were just college players, what a difference I could make. So I set out, talked to lots of different people, interviewed a lot of people in our neighborhoods, coaches, and 2 other moms co-founded an organization called Sow Good Now. And that we started in July of 2018. And the name of the organization is Sow, like sowing seeds of good now, with advancing philanthropy through high school and college athletes being at the heart of our mission. Like, don't wait until you're 65 to think about how you want to give back.
That's great. And just as another quick aside, I mean, Carl's story was phenomenal from high school, and he just had a work ethic. Everything I've seen that took him from walk-on at Penn State to what was he, the like Big Ten leading sack, in his senior year, and then off to the NFL. I mean, it was all about commitment and work ethic that really made it happen for him, from what I could tell. That's says a lot about you and your guidance over the years, and how you brought your boys up as well, and your girls. Tell us a little bit about the give back, and how is that structured, and how does that work?
It's a good question, one that a lot of people ask me about. So we are a youth philanthropy organization, and if you think about rare diseases in the world, the industry of youth philanthropy is a very rare disease, in this case a very good producing one. And there as of, I guess, 2021, there were roughly 500 youth philanthropy programs in the United States, and most of those programs are delivered in a classroom setting with an after-school program, but ours is different. So you just talked about Carl's work ethic. And if you think about all the team members on a sports team that have that same work ethic, we integrate our sports philanthropy programs into the culture of high-performing teams. Why is that? Why is that so important? It's because one of the first steps in building a youth philanthropy program is to get a diverse group of young people and have them meet regularly. So high school and college sports are naturally diverse, and they are naturally well organized and meet regularly. So we already have a leg up there.
Hey, Mary, it's kind of interesting listening to your story. Being a Penn State graduate and a season ticket holder, I watched Carl play.
Did you? Cool, that's awesome.
I did. I've spent many an afternoon on Saturday afternoon in Beaver Stadium watching him. So, kudos to he was a walk-on, and now he's in the NFL, and that doesn't happen very often. So, but we know sporting activities are really good for youth. I mean, I have 3 sons myself, and I coach them for years and years. Why do you think athletes are well positioned to lead us in philanthropy?
That's a great question. And I'm so glad to know you were in the stadium there with me. Those were some crazy times. The seats are so tiny, though. You have to get to know the people next to you.
On cold days, it keeps you warm.
That's true, right? I did meet my best friends there. Why are athletes well positioned to drive youth philanthropy forward, right? Because in order to be a good community leader, you have to be comfortable taking risks, and you have to be comfortable with failure, and you have to persevere. So by the time you're a high school or college athlete, you've made a lot of mistakes, right? How many swings did I take as a volleyball player? How many went out? How many went into the net? And how many were blocked by an opponent? That doesn't give you any excuse to not show up and do it again. So when you think about the challenges that we're facing in our country right now, and you think about the attitude that you need in order to make headway, athletes are very well positioned. And additionally, the one thing that they have that other young people may not is a following, right? In order to be a leader, you've got to get people to follow you. And I think college football, there are 80 million viewers, maybe a weekend or a day, I'm not even sure, but a lot of people follow college football. And the numbers are 45 million youth engage in organized sporting activities in the United States annually. So if you want to get a good thing going, we believe that the athletes, those high school and college athletes, are a place to drive it.
So, so Mary, how do you reach these athletes, and how do you actually structure the program for them to do their giving back?
Thanks, Mike. It's the way we structure our give back programs, and that's what they're called, is they are an annual event that is takes place after months of meetings and preparation, and we partner a high school or college team with youth from an underserved area. Our curriculum is one that's based on a multitude of sources. Some are big providers, some are smaller providers. But the curriculum itself could be considered a core workout if you're thinking in terms of, how do you get yourself in shape in a very short period of time? Those in the fitness world know how to do that. So our model is one where our curriculum is activity-based, and it's integrated into this give back event through the collaboration of the partnerships of the high school and college athletes, as well as kids from underserved areas.
So are you reaching out directly to athletes? Or are you going to the athletic director at an organization? How do you find the participants for the program?
So the entry points can be many. The athletic director is a yes. Sometimes players stop me and ask me that they want to get involved. I've had young community members say, I see on your website what you're doing. I want to do that. So we give them the tools. But to broad source the give back, it would be through, and we're kind of moving in that direction now, is to create partnerships with larger institutions that have multiple facilities at youth serving organizations, as well as multiple teams at different high schools and colleges. So it would be coordinated through the athletic director, through the service director, and through the executive directors at the youth serving organizations, as well as other community partners that have a vested interest in serving the same population that we do.
Mary, I've got to applaud you for the work that you're doing, because, as in life, what we often find is, even in college athletics, you hear more about the bad decisions that student athletes make, and you very rarely hear the good stuff. You don't hear about the philanthropic efforts that people have. So I think it's fantastic with the work you were doing, and I would like to see more of it, quite honestly.
Well, thanks, Dan. I was listening to you talk in talking about EFTs and different challenges that the banks are facing, and we're in the midst, from a financial perspective, in addition to highlighting the good that people do in general, specifically athletes, is so important, and to get that word out, because it does have a ripple effect. But that with the intergenerational wealth transfer that's taking place, and the fact that the next rising generation wants to talk about philanthropy, our model is one that a lot of the financial advisors are getting behind, because it shows their client base that they are promoting philanthropy, and it's in a fun and engaging way where everyone learns together. So adding that component to your practice is huge, as well as highlighting the positive effects in athletics.
Hey, Mary, can you give us an example of one specific give back, maybe exactly how it worked, who funded it? And I'm sure funding is always, something that you're in need of. How would you go about attracting additional contributors?
Yeah, absolutely. So we've been funded primarily by private donors and partnerships with other foundations. We are happy to work with anyone who wants to look into learning about philanthropy, engaging their community in philanthropy, they can certainly reach out to me directly. And we can talk about that. Donations are accepted on our website. We have a golf outing coming up May 22nd. Would love to have anyone in the area. It's at Penn Oaks. Love to have anyone in the area. Also, Chester County Community Foundation and the Delaware County Community Foundation knows of our work and would be able to get you in touch there if you have existing relationships. But we do teach a lot. It's very high level. We are looking at building the next generation of philanthropic athletes. And it's a pretty intense training, but it's done in a fun and engaging way. So we would hope that people would want to get involved.
Do you find, Mary, that you tend to gravitate toward more of one particular sport in general, or is it just across the board college athletics as a whole?
So Dan, that's a great question. And we've been piloting different sports, and just like different teams have different cultures, and there's pros and cons to those cultures. Sometimes the youth are very engaged and really good public speakers, and that part of their give back excels. Other schools are, for different reasons, more experienced in the nonprofit space, in the fundraising space. So they may excel in that area, but may not be as good interacting with the kids or as experienced as interacting with the kids in that setting. So that's why all of those points are very important, because developing several different skill sets consistently through the model is what our goal is.
So I know when we talked once before, you had a golf outing where you actually provided golf clubs to the participants in it.
Yeah, with Westchester University men's and women's golf teams, we took 40 kids from Coatesville and we did a golf club drive. And all of the kids got their own golf clubs, and they hated it at first, which is what's so thrilling to me the first time. And they get out there, and the players have to work through, oh my gosh, how do I get this person to a place of confidence? So to see that transformation is wonderful. And at this golf give back, saw this little 9-year-old boy. He was swinging. He was so mad. And then eventually by the end of the day, he's there hugging his golf set. And in particular, he has this one club that he knows he can get a good hit with. And so what we see is that, they talk about bringing light to communities. What I see that light is getting a kid to believe in himself for that day, for that moment. And when he goes back to where he came, he's going to feel just a little bit lighter and a little bit more advanced. And if someone says, hey, do you play golf? He's going to say, yes, I do. So that's
phenomenal. Yeah. Very inspirational, Mary. I appreciate your time on the show today. And, I hope people watching this can help out and support your philanthropy. It's doing a good cause.
Thanks, Mike. I really appreciate the opportunity. And Dan, it's great talking to you too.
Great. Thanks, Thank you very much. Mm-hmm. Our next guest on Money Matters TV is Tom Dunkel of Bill Rose Storage Group. And thank you for watching Money Matters TV. And until next time, this is Mike Dever. See you next time.